Hi there, welcome to Quantum Economics and another session. This time we're going to be looking at what roiled markets this weekend. There is no doubt that markets were roiled. There was a big drop in the value of bonds as yields rose and equity markets were in turmoil. Although the S&P ended the week only down about 2%, the reality is that volatility has come back, and volatility really matters because your risk-adjusted rate of return is adjusted by volatility. So you're not getting paid as much for risk as you used to. So you need to know about volatility because it affects the value of your money on the day you want to avail yourself of it. So first of all, that's the evidence for markets being roiled. Now let's talk a little bit about why. First of all, a little hark back to the first three sessions of quantum economics and what it means. And then we look at some of the more intricate details. First of all, back to QE. We conceive of our existence and forecast our existence in terms of big, stable objects. Chairs, tables, or spouses, or expensive or inexpensive motor cars, and bicycles. But of course, the universe is not composed of big objects. It's composed of subatomic particles which make up big objects, but don't behave according to the same logic or in the same way at all. Therefore, as we are made up of such particles, we too conceive of our existence in one way, but we actually exist in a way which doesn't obey the laws of big objects. And when we were looking at this in terms of how you think about financial markets and how you think about economics, we came to the recommendation that you think about them not as big objects, but as disruptive, sometimes illogical and incoherent events, which can tear up comfortable consensus. And at that time, some of those subatomic disrupting events that we talked about in our quantum economic way of looking at the world were the return of inflation and the possibility that governments would incur the sort of debts and deficits which would eventually become unsustainable, and the market would fear this before it actually happened. And indeed, that's where we are. We have reached, according to what we saw last week, a reversal point on stimulus to offset the effects of COVID. Before, the markets were like junkies and the economies were like junkies. The more stimulus that governments or central banks injected into the arm of the economy, the happier the economy felt, the happier the markets went. But now that is reversed. In fact, the reversal point on stimulus says that more is now less in terms of outcomes. That means that there is a negative sign in front of market reactions to increased stimulus. Now, why is that? Okay, well, it's pretty simple stuff, really. Fiscal stimulus now, just take the US, but frankly, all the economies, particularly the big ones, rather than the emerging markets, are the same. In the US, the additional amount of stimulus, which is now being planned by Joe Biden, who is a thoroughly honest, decent man, but may go down as the first US president who was an honest, decent man, but couldn't add. This stimulus is 8 to 9% of US GDP. That's the package which is wending its way through the political process at the moment. And that will generate at least 6% growth in the economy. Now, we have to remember that the US economy is a grand old lady, and asking her to grow at 6% is like asking an octogenarian to jive. It is not particularly seemly and can cause considerable damage. And in the case of asking the US economy to grow at 6 or 8% and pumping in the amount of money to make it do so, you are actually exceeding its ability to grow at about 2%. And the result of that will inevitably be inflationary pressure, cost pressure, and disruption, irrespective of the amount of labor market slack there is or there is not. In other words, you cannot really deal with a dysfunction in the labor market, which there undoubtedly is, by using monetary and fiscal stimulus rather than structural policies. And that is why these policies will generate the sort of outcomes which financial markets will not like. Now, part of this is the size of debts and deficits. For example, the US sovereign debt ratio, that is the ratio of the amount of money the government owes to GDP, the amount of things that the US produces, this year will rise to over 100%. That's getting on towards Italy, which nobody actually, with all due respect for the new government of Mario Draghi, nobody really wants to emulate. Worse than that, the fiscal deficit in the United States, including some 2% to be spent on infrastructure, is probably going to be around 20% of GDP in this year. Now that, in the world's largest economy, the world's biggest funding markets, and the world's reserve currency, is simply unacceptable to financial markets. What it tells you is that yield curve control, formerly known by the jargonists as YCC, seems inevitable. It's inevitable everywhere. It's probably already happening in drag in Europe, but carefully disguised and hidden in a cupboard. And of course, it's been going on in Japan for years and years and years. Yield curve control basically means that the central bank buys enough bonds in order to stop financial markets pricing risk. So you control the yield of long-term financial assets. The reason that this may be going to happen in the United States as well as everywhere else, where it is already happening, is quite simple. It is because governments can't spend that sort of money, 1/5 of the output, and have a deficit equal to 1/5 of the output of its economy, unless it can control the cost of borrowing that money. So you have to push down the cost of borrowing to zero and have it negative in real terms, so that the government is kind of self-liquidating its debts and can pretend that these debts will actually go away. That is what we are facing, and that is what financial markets woke up to this week. Now, of course, you might ask yourself, well, why did financial markets wake up to this week and not before? After all, long-term bond yields have been rising since August. And we have been talking about this as two of the major disruptive particles since we first published our quantum economics thesis several months ago. Now, why did they wake up this week? And the answer is because markets are not efficient and intelligent. They are actually inefficient and rather dumb. They have an intellectual deficit, and that is because they're full of people who can only think of one thing at a time. And as long as things are going up, everything is fine. That is cause and effect. And when things are not going up anymore, things are not fine anymore. And then because they're not fine anymore, markets start to go down. Now that may strike you as highly simplistic reasoning, but then the markets are full of highly simplistic reasoners. Let's look at the long term. Is this going to be a momentary blip? Well, first of all, when governments start to spend that sort of money and get that sort of power, it's never a momentary blip. It goes on for decades and is actually part and parcel of the return of inflation, because inflation is the only way that governments can get rid of those debts. They pretend to pay, but actually they inflate them away. And that is exactly where we are going to go. And of course, that sort of outlook is not particularly good for bonds, and it's actually not very good for equities, even though there are people in the markets today who say, oh, equities are a great hedge against inflation. They are most certainly not. That, if you look back at history, has never been the case, and it even is economic rubbish. For example, if equities are going to offset inflation, then output prices of companies have to continue to rise faster than the input costs of companies. They never do. Actually, what inflation costs us is push up the input prices of corporations faster than the output prices of corporations. The result is declining real profits. So don't fool yourself that inflation coming back is going to be, you're going to be able to assuage the effects, shield yourself completely against the effects by buying equities. That is simply not true. Now, will the inflation then be a permanent feature on our landscape, or is this something which is going to go on for a couple of months and then go away? But it's simply something caused by a particularly fast economic recovery after COVID, which creates a few supply side distortions. And then by midsummer, it's all gone away and the Fed is right and we all live happily ever afterwards. Well, let me tell you 4 reasons why I don't think that is true. It is not true because under the quantum economic way that we analyze the post-COVID world, we see a dramatic shift in the economic architecture of the Western world. And indeed, Japan has achieved that change ahead of us all. What are those changes in the architecture? Number one, the reversal of globalization, because nobody's going to play ball with China anymore. And therefore, and because of COVID, a return to a nationalist economic policy. Nationalist economic policy means Italians have got to buy Fiat motor cars and Americans have to buy American motor cars, both of which are not great and which frankly give you worse value for money than other options. So therefore that's inflationary. Big and inefficient government is going to be with us with its debts and deficits, which in turn will lower productivity and will increase inflation. That is the result of COVID. We all want nice, kind governments. Nice, kind governments are big governments which give handouts to people who can't, survive and have decent lives on their own, which is a big ethical issue. But the reality is that when governments get to deal with these problems, they do so in an inefficient way, which raises inflation and lowers productivity. The third is that part and parcel of all the measures that were introduced to deal with COVID were huge guarantees on loans and direct subsidies to corporations which basically had no message for humanity. These corporations with no message for humanity are called zombie corporations. In other words, they just wander around the economic landscape, employing people, paying people to pretend to work and producing nothing that anybody really wants. And the zombie corporations at the last count, which was done by the BIS, Bank for International Settlements, were about 18% of all the quoted corporations in stock markets around the world. We reckon they're now about 30 to 40%. So 30 to 40% of zombie corporations means that the corporate landscape is not going to be particularly productive, and less productivity means more inflation. And finally, and perhaps more importantly, and we've said it before, the biggest heritage of COVID is going to be inequality and polarization. Those who are weaker economically, those who are not wired to work at home, those who are ladies who have disproportionately lost their jobs during the COVID crisis, the emerging markets which really do not have any way of winning in the post-COVID world, all of this creates inequalities. Now, what comes out of inequalities? Two things comes out of inequalities and polarization. One is societies do not function as a whole. So populism comes back in some form or another. Populism can only be limited in its political impact and therefore economic impact if the government in power, which presumably is less populist than what could take over as a real populist government, if the government in power actually pays people not to vote for populists. That of itself is inflationary. And secondly, of course, we have the problem of emergent economies around the world, which not being as wired or linked in to the new way of doing things or the nationalist way of doing these things which will emerge from COVID, these are also at the losing end of income distribution and wealth distribution. So those polarizations are going to be major economic policies, which is going to be extremely hard to solve. And it is most likely that the easiest but illusory solution for the world will be for semi-populist governments to dish out money and create inflation so that real populist governments do not take over our lives. That's it for this week. Don't think that what you saw in the markets this week is just a one-off event. It is actually a kind of gong, which is telling us that these events are there. I don't think they will be short-term in their effect, but neither do I think that markets go down in a straight line. And there will be sighs of relief along the way, but the destination is quite clear. Thanks a lot for watching. It was better now.